In view of negative interest rate by loose monetary policies, which aims to stimulate economy, but fears are rising because of asset bubble being created. So investors, they want to know how to optimize their portfolio. And today we invite an expert in fixed income market, Phillip Gronninger. He's a client portfolio manager at Janus Capital Group. Hello, Phillip.
Hello.
Hi. And Phillip, could you give us your view on global economic outlook for the next 12 months?
For the next 12 months at Janus, we believe that global economic growth will be rather slow. The U.S. will be relatively strong in comparison, with perhaps GDP near 2%, but the rest of the world will remain rather muted.
What about the U.S. President elections on November? Do you think it will affect the market, the volatility will be more stronger?
We do believe that volatility will increase into and after the elections in November.
Yes.
And we think that should be of heightened concern for investors today.
Okay. Then what about the other concern? Many people, they think about the Europe. They have electoral uncertainties. Is still continue. Like in Italy, they will have election too in this year. So is it the other concern for the next 12 months?
Yes, at Janus we believe that European growth will be quite challenged with election cycles over there, particularly throughout the Eurozone, where you have multiple fiscal policies under one monetary policy, and that will lead to continued challenges for growth rates in the Eurozone.
Okay, and might be another black swan again in the 12 months. Do you think any potential risks is?
We think that the tail risk concern is a low probability of a black swan type event.
Okay.
However, we do think that investors should remain cautious because at least in the U.S., we're in the late stages of the economic cycle with relatively strong growth versus the rest of the world.
Yes.
However, caution is warranted.
Okay. And then what about in Asia, Bank of Japan, because we see the falling rates and the rising Japanese yen? And what about the Europe, ECB and China?
Yes, we think that in the ECB, the Bank of Japan, and the Bank of China will continue to do everything they can to try to stimulate the economies, which means aggressive accommodation, aggressive monetary policy, and perhaps on the horizon some fiscal policy changes as well. And those could take years to have effect.
Okay, so in the short term, you don't think it will have like huge change for this government?
We don't expect dramatic changes in the near term from central bank policies. Markets, we believe, are starting to question the efficacy of central bank policies, and that could lead to challenges for both rates and risk assets globally.
Okay, now we're talking about what about the government bond? It's also related to the policy, the monetary policies. What's your view of the government bond? Which region is your favor?
Yes, currently, when looking at the developed sovereign market, about 35% of developed market sovereigns are at negative yields today. When we look across the world for yield and opportunity, we continue to favor U.S. rates because on a relative scale they're much higher. We have found some opportunity globally in New Zealand rates, a bit in Canadian rates, Mexico, and we have a little bit of exposure to Italy and Spain. We have been avoiding the negative rates wherever possible.
Then what about the high yield market? What's your view of this product?
With respect to high yield, we're very positive on high yield. We know that investors are searching for income and yield. And while the high yield market is relatively rich, we think that the technicals will be very supportive as investors continue to put money in search of income. However, we would exercise quite a bit of caution there because we are in the late stages of the economic cycle, and companies are beginning to re-leverage their balance sheets by rewarding shareholders through dividend increases, share buybacks, and M&A activity. So we've seen leverage ratios on the rise.
Because the high yield is related to the economic growth. Now you say it's the cycle's the latest the stage, right? So for the next 3 to 6 months, is it good for the high yield market?
Yes, we do believe for the next 3 to 6 months it is good for the high yield market. Continued positive flows into the high yield market are very supportive of tighter spreads. However, we do think that longer term, with companies re-leveraging their balance sheets, investors should be cautious of holding on to high yield for too long.
Okay. And so do you have any suggestion for the fixed income investors?
Today, we would say that investors should be very cautious on interest rates globally. While we think they will remain low, one should not extend the interest rate sensitivity or duration of the portfolio too much. Additionally, when looking at risk assets such as high yield, security selection is extremely important. So fundamental analysis will be very critical to building a fixed income portfolio.
For these investors, how they do the fundamental analysis? Which tool they could use, or which information they can?
Certainly, when one looks at, say, the high yield market, the high yield security market is very heavily skewed from a return perspective towards the commodity related sectors. And we're very cautious there. So we're looking for what we consider late stage cycle companies that will continue to do well should we see an economic slowdown globally.
So Phillip, could you give any suggestion to the fixed income investors?
Yes, within a fixed income portfolio, one should be well diversified with a large amount in government securities. And again, we favor U.S. Treasuries right now when we look at global sovereigns. And those provide a low to negative correlation to risk assets. We do like investment grade corporate credit, as well as high yield corporate credit and mortgage-backed securities. Within the mortgage-backed securities, just generic agency pass-throughs. They offer a nice bit of yield over the treasuries with less volatility than the corporate credit. We would continue to hold a little bit of cash because the fixed income market has become much less liquid over the last 8+ years, so it's more challenging for investors to reposition fixed portfolios today.
Okay, some people they suggest you should put like 60% in the equity market and 40% to the bond market. And so how to allocate this 40% bond market?
Sure. So within the 40% fixed income sleeve, we would think that half to 3/4 of that should be in a core fixed income investment product, one that's well diversified, again using U.S. Treasuries, corporate credit, mortgage-backed securities, a little bit of asset-backed and commercial mortgage-backed securities. For the additional fixed income allocation, investors could add some more yield to their portfolio by allocating a bit more to a high yield product or an unconstrained type strategy where the correlation will be a bit higher to equities, but perhaps the return opportunity could be a bit greater.
Okay, thank you, Phillip. Your advice is really helpful because now we are having a very low interest rate world. Your money put in bank, you will get nothing. So it's very important for fixed income investors to allocate the asset. And thank you again, Phillip, to join us today.
Well, thank you for your time.
Thank you.